Hello and welcome to this video. In this video, we are going to do a A-level question from paper 3, Feb-March 2023, question 1. The question says that J Limited is a manufacturing business. It applies the rate of factory profit of 20%. The following information is available for the year ended 31st December 2022. Sales revenue is $936,000. Purchases of direct materials is $216,000. Direct labor is $196,200. Factory overheads is $85,000. Administrative expenses is $234,000. Sales and distribution expenses is $97,000. Increase in direct material inventory is $1,160. Decrease in work in progress inventory is $960. Increase in the provision for unrealized profit is $600. Finished good inventory at 1st January 2022 at transfer value was $26,400. In the A-bit of the question, we are asked to give two reasons why business may apply a rate of factory profit. You see, factory profit is a percentage which is added to the manufacturing cost when we manufacture the product in our own manufacturing unit. So, factory profit is the difference between the market price, that is the price at which we can purchase this product externally, and the price of producing the product in-house. So, when we are checking whether we are producing the product in our own manufacturing unit at a lesser price, that means our manufacturing unit is more efficient. So that is one of the reason or one of the benefit why we take the factory profit, as it helps in gauging the efficiency of our factory operation. Apart from that, we transfer the products when we manufacture in our manufacturing unit to the retail unit at a transfer price, and this transfer price is the cost of manufacturing the product plus the factory profit, and this acts as a benchmark, because now when we have a benchmark, we will know that whether we should make the product in our manufacturing unit or buy it externally, which is more beneficial or which is more cheaper. So this gives relevant information to the management when they want to decide whether the product should be made in-house or to buy from the external sources. In the B bit of the question, we are asked to prepare the provision for unrealized profit account for the year ended 31st December 2022. You see, unrealized profit occurs when we add a factory profit to the cost of production when we transfer this goods from manufacturing unit to retail unit. We transfer it at a transfer price, and this transfer price also includes the factory profit, and as this profit have not been earned, it has not been released, hence it is called as unrealized profit. And as it is not earned based on prudence concept, this should not be taken into consideration, hence we make a provision for this, which is called as the provision for unrealized profit. And we have a formula for provision for unrealized profit, which is equals to opening inventory, it can be closing inventory, it is actually the inventory which of finished goods which are transferred to the retail unit at a transfer price, times the markup percentage divided by 100 plus markup percentage. Till the time we are talking about the factory profit, and if it has not been mentioned in the question that there is a profit margin which is stated in the question, we will consider the factory profit as the markup profit because we add it to the cost. So whatever factory profit given here will be taken up as the markup profit. Here it was mentioned as 20%, and the opening inventory on 1st January 2022 was given as $26,400, and this was also mentioned that it was on transfer price. So when we take this and calculate it, that is the markup or the factory profit was 20%, so 100 plus 20, we get the value provision for unrealized profit on 1st January 2022 as $4,400. Now we will make the account for provision for unrealized profit. So whenever we make an account for provisions or for liability or for capital, the opening balance will be always credited. So here the beginning balance, which is the opening balance which we have calculated, will be credited as $4,400. It was also mentioned that there was an increase in provision which was transferred to profit and loss account. Whenever there is an increase in provision, that means there is an increase of unrealized profit which have to be deducted from our profit. And whenever there is an increase in provisions or in liabilities or in capital, it will be credited. Hence we have credited this because this lead to increase in provision. So we have now the total of $5,000. So we balance it by taking it as a closing balance as $5,000, and we close the account for provision for unrealized profit, and we bring down the balance for the next period. Furthermore, additional information is provided which states the direct labor cost includes $3,000 for workers repairing factory machinery. Second, the office equipment cost of $10,000 purchased in January 2022 was classified as factory machinery. Both office equipment and factory machinery have been depreciated at the rate of 10% per annum using straight line method of depreciation. And third is J Limited obtained a loan to buy a delivery van. The interest on this loan was $4,000 and have been included in selling and distribution cost. In the C bit of the question, we are asked to make the manufacturing account for the year ended 31st December 2022. So we'll start with the working note. You see, when we start making the manufacturing account, what we do is we will first find the cost of direct material consumed, and for this we have a format, that is, we start with the opening inventory of direct material. To this we add the purchases of direct materials, and from there we subtract the closing inventory of direct material, and we will get the cost of direct material consumed. However, in this question we have not been provided with the information about the opening inventory of direct material as well as the closing inventory of direct material. However, it was mentioned that there was an increase in the direct material inventory on 31st December 2022. So for this, what we are going to do is first I will explain you with an example, and then we will proceed and calculate the cost of direct material consumed. Suppose in our example we have the opening inventory of direct material, which is given as $4,000, purchases is given as $10,000, and the closing inventory of direct material is given as $6,000. So we have all the information. It will be very easy to calculate the cost of material consumed, as we take the opening inventory of direct material. To this we add the purchases of direct material, and we subtract the closing inventory of direct material. We will get the value as $8,000. However, here we don't have all the information. What we have is purchases. We have the increase in the direct material inventory at 31st December 2022. That is, the closing inventory have been increased by this value. So if we use the same example here, we don't have the opening stock. We just have the purchases as 10,000, and here we have the increase in the direct material inventory, that is increase in the closing inventory of direct material, which it will be $2,000, because the opening inventory is 4,000 and the closing is 6,000. So the increase is 2,000. So we take the $10,000 and we subtract this $2,000, which is increase in the closing inventory. We will get the cost of direct material consumed, same as 8,000 as we got it here. So this is also another way of calculating the cost of direct material consumed, where we have the information about the purchases and the increase in the direct material inventory at the end of the year. So in the same way, we are going to use the information and calculate it for this question. That is, the information given here was the purchases of direct material was $216,000, and the increase in the direct material inventory on 31st 12/2022 was $1,160. So when we subtract this, we get the cost of direct material consumed as $214,840. Then further additional information which is provided states that the direct labor cost includes $3,000 for workers repairing factory machinery. You see, direct labor cost is the cost or the wages which we pay to the employees who are directly involved in the production. Like if we are in a manufacturing business, we are manufacturing wooden furnitures. The cost which is paid to the carpenter, or the wages which is paid to the carpenter, will be the direct labor cost. And when they are paying here for the repairs of factory machinery, this is not the direct cost, this is the indirect cost or the overhead cost. So what we will do is we'll take the direct labor cost, which was given as $196,200. From there we subtract this $3,000. We will get the direct labor cost as $193,200, and then the factory overheads, which are your indirect costs, and this is a part of the indirect cost, that is the wages which is paid for the repairs of factory machinery, will be the part of your factory overheads. So we will add that to the factory overheads. We'll take $85,000. To this we add $3,000. We'll get the factory overheads as $88,000. Furthermore, additional information which was provided was mentioned as office equipment cost of $10,000 purchased in January 2022 was classified as factory machinery. Both office equipment and factory machinery have been depreciated by the rate of 10% per annum using the straight line method of depreciation. You see here, this machinery which was office equipment was considered as our factory machinery, and as it was considered as factory machinery, the depreciation for this machinery, that is for 10,000, 10% is $1,000. This was included in the factory overheads, and it should not be included in the factory overheads. It should be in the administrative expenses, and this should be a part of profit and loss account, not a part of manufacturing account. So what we will do is we will take the factory overheads, which is here we got it as $88,000, and from there we subtract this $1,000. Now our factory overheads will be $87,000, and our administrative expenses, which was mentioned as $234,000, to this we add $1,000. It will be now $235,000. Next, there is also some of the workings required for work in progress. You see, work in progress in our format, what we do is we take the opening work in progress inventory and we add this. From there we subtract the closing work in progress inventory, we subtract and we get the value, and then we use it in our calculation for manufacturing cost. However, here we don't have opening inventory of work in progress and closing inventory of work in progress. Again, I will explain you with a numerical example, and then we will proceed and calculate it, and then we will make the manufacturing account. For example, we have opening work in progress inventory as $5,000 and the closing work in progress inventory as $4,000. So what we will do is we will take the difference, that is $1,000, and then we calculate our manufacturing cost. However, it was not mentioned as opening work in progress inventory and closing work in progress inventory. We have three types of inventory when we talk about manufacturing account. We have inventory of finished goods, we have direct material inventory, and we have inventory of work in progress. So in work in progress, here what we are going to do is we are going to take the difference and then we will proceed. So here what was mentioned is here the difference which we got was $1,000, but however it was mentioned in the question that the net decrease in work in progress was given there. That is, here net decrease in work in progress, out of 5,000 it is 4,000, so net decrease is $1,000, and this, as this is a positive, we will add it in the manufacturing account. So here what was mentioned was there was a net decrease in work in progress inventory at 31/12/2020, and this should be added. So either you can understand it with the help of a numerical example and proceed with how to deal with the inventory requirements, or what you can do is you can just remember this, that is, if there is an increase in inventory at the end of the year, this will be the closing inventory and hence should be subtracted. And if there is a decrease in the inventory at the end of the year, that is, a closing inventory have been reduced at the end of the year, this should be added. Either you memorize this or you understand it with the help of a numerical example, and then you can use this and proceed further and make the manufacturing account. Manufacturing account for the year ended 31st December 2022. We take the direct material consumed, which was calculated in the first working notes as $214,840. Then the direct labor, which was calculated in the second working notes as $193,200 prime cost, which is the total of direct material consumed and direct labor. We will get the value as $408,040. Then the factory overheads, which was calculated in the third working notes, it will be $87,000. When we add this, we get $495,040. Then Decrease in work in progress inventory, which was explained in the fourth working notes as $960. So when we add this, we get the cost of good manufactured as $496,000. This is the cost. On this we will add the markup, that is 20%, that is cost times 20%. For $196,000 times 20%, we get the factory profit as $99,200. So when we add this, we'll get the transfer value of finished goods, which will be transferred to the profit and loss account. In the debate of the question, we are asked to prepare the statement of profit and loss for the year ended 31st December 2022. We'll start with the working notes. We have already made the provision for unrealized profit account in the first bit of the question. There we got the closing balance of provision for unrealized profit as $5,000. We don't have the closing inventory of finished goods at transfer price value, so I'm taking this as CI. The markup, which is the factory profit, 20% divided by 120%. When we apply this in the formula, 5,000 is equals to 20 CI by 120. When we cross multiply it by transposition, we get 5,000 times 120 divided by 20. So our closing inventory of finished goods will be $30,000. Furthermore, there was additional information which was provided that J Limited obtained a loan to buy a delivery van. The interest on the loan was $4,000 and had been included in the selling and distribution cost. You see, this interest on loan will not be a part of selling and distribution cost, it will be a part of financial cost. So we will subtract this. We'll take the selling and distribution cost, which was given as $97,000. From there we subtract this interest of $4,000. We will get the selling and distribution cost as $93,000, and this $4,000, which is the interest, will be the financial cost. The statement of profit and loss for the year ended 31st December 2022. We start with the sales revenue, which is given as $936,000. Then from here what we are going to do is we are going to subtract the cost of sales. In cost of sales we have the finished goods of opening inventory, which was given as $26,400. The goods at transfer value, this is which we brought from the manufacturing account, and this was $595,200. The finished goods of closing inventory, which we have calculated in the fifth working notes as $30,000. So we take the opening plus the goods which have been transferred from manufacturing account, and from there we subtract the closing inventory. We get this value as $591,600. When we subtract this from the sales revenue, we will get the gross profit from trading as $344,400. Then we have the factory profit, which we have calculated in our manufacturing account, and it was mentioned that the unrealized profit was increased by $600. That means whenever there is an increase in unrealized profit, it has to be subtracted, and so we subtract the $600. We get the factory profit after subtracting the increase in provision for unrealized profit as $98,200. Then this is the gross profit from manufacturing. We add the gross profit from trading and from manufacturing. We get the total gross profit as $443,000. From there we will subtract the administrative expenses, which we calculated in the third working notes as $235,000. Then the distribution cost, which was calculated in the sixth working notes as $93,000. We get the profit from operation as $115,000. From here we will subtract the finance cost, which was calculated again in the sixth working notes, which was $4,000, which was the interest which we have paid. And once we subtract this, we get the profit for the year as $111,000. Furthermore, additional information is provided which says that the sales manager of J Limited received a sales order at the value of $40,000 from a new customer in a country that J Limited had never traded with. The new order allows J Limited to earn the same gross profit margin, but an additional 9,500 transportation cost will be incurred. In the EBIT of the question, we are asked to advise the sales manager whether or not J Limited should accept the sales order, and we have to justify our answer with relevant calculations. First, we will calculate the gross profit margin. For gross profit margin, we have a formula that gross profit margin percentage is equals to gross profit divided by sales revenue times 100, and the gross profit which we have calculated, the total gross profit which we got in the Profit and loss account statement was $443,000 divided by the sales revenue, which was given as $936,000 times 100. We will get the gross profit margin as 47.37%, which is rounded off. And here the sales order which we have is for 40,000. The value is 40,000. When we multiply it with 47.37%, we will get the gross profit as $18,932 for this order, and from here we have to subtract the transportation cost, which is $9,500. So the profit which we get from this sales order will be $9,432. So our profit will increase, hence we should accept this order. Apart from that, we will also enter the new market in the new country, so this may lead to further expansion for J Limited, hence we should accept the order. However, when we are entering a new market in the new country, there may be some factors which may be risky, like the political reasons, if there is political instability in that country, or the foreign currency issues like the exchange rate. The foreign exchange rate may keep fluctuating, so that may be a problem, and then there will be additional administrative cost. However, the drawbacks are lesser when compared to the benefits. So as the benefits outweighs the drawbacks, hence the sales manager should accept this order. With this, we have completed this question. Thanks for watching my videos. Have a peaceful and blessed life.